Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to look at a bunch of different uh, ratios that I don't really go over all that much. And a lot of them are commodities in relationship to stocks or the Dow Jones Industrial Average. I may pull up a bond to gold ratio like a TLT in relationship to gold, just to give you guys a little bit different picture and viewpoint. And what it tells us is what assets are cheap, how they're performing against each other, if money is flowing into or out of certain assets, or money is preferring other assets, even though they could be flowing into both at the same time. But it gives you a picture of the market conditions and the environments that we're in. In a disinflationary environment, what you'll see is stocks outperform commodities. In an inflationary environment, you'll see stocks and bonds underperform gold and other commodities as well. So the market conditions when I keep saying market conditions, what that is, it's the environment that humans are trading under. So when humans trade under certain environments, they prefer certain assets and money flows differently. So in an inflationary environment, if we were to do a controlled experiment, put a bunch of humans into a room and say, how would you behave if inflation was 10%? They would sell bonds because you'd have an increasing interest rate environment. You would move money into commodities or precious metals or whatever they would do. They would move it in a way differently than a low inflation, low interest rate environment. So that's really what we're gauging, is we're gauging the market conditions and the environment with these ratios. And it also tells us, one, what the environment is, how it's changing, money flows, and if it's expensive or cheap in relationship to history. It tells us all that information when comparing an asset to an asset and looking at it through time. So let's look at it. Let's dive in, and we can look at a bunch of different ones. What I've got here is the Dow Jones Industrial Average divided by gold. And this is a big, long-term, big picture view. It goes all the way back to 1897 at the beginning of the chart, all the way till today. This portion here, the Federal Reserve was created in 1913. This was before the Fed, and you can see that we had a pretty stable environment here that just basically wiggled back and forth. The free market would self-regulate itself with no central bank, and it would have little boom-bust cycles. But overall, the market would stay relatively stable. After 1913, when the Fed was put into power and put into place, you could see that the volatility started to kick up, and we had these big boom-bust cycles. And that's what we're going through right now. And if we look at it, this was the 1929 stock market crash, and we turned and went down lower, where gold outperformed the Dow Jones Industrial Average. That went from a booming time, lots of credit expansion and money coming into the system, to a deflationary bust and a housing market collapse. This here was the bottom, 1942. This here was in a credit expansion phase. This was a demographic coming back from the wars, having babies, doing all that stuff, and had a massive housing start boom. It was a big housing market boom all the way till the demographic somewhat slowed down and got really inflationary. I shouldn't say the demographic slowed down. The demographic sped up, and it became very inflationary. That's what this was up here. And this was an inflationary time all the way back to the bottom here. So this was highly inflationary here. This is where they revalued gold, even though we had a deflationary bust. And so this was when the stock market did very well. This is when the stock market did very well. This is when commodities and precious metals have done very well. So that's what it looks like for this ratio chart. That's what it's telling us. And this here was the tech boom in 2000, 2001, massive revaluation lower. We also had an expansionary phase of real estate, and it was inflationary. That's what all that is. And the pricing of the assets got priced differently with that inflation and pricked this bubble. We have the same type of environment, in my opinion, coming up, and we are going to go downward where gold is going to outperform the Dow Jones Industrial Average. One could also throw in a trend line here and say, well, the trend line's right here. We're getting close to this breaking to the downside. Once we break it, it's going to be game on for precious metals and the commodities itself. But right now, we've got a strong move lower with gold outperforming the Dow Jones Industrial Average, which is favorable for commodities and precious metals. We could get a very strong contraction. So when we look at this and we kind of zoom out, these bottom of the markets typically get to, this one's around 2 or 3 to 1, which means Dow Jones is 2 times expensive as gold. This one went all the way down to about a 1-to-1 relationship. We are going to move lower, and I'm not going to pretend I know exactly where it's going to go, but there's a strong likelihood that we could get back down to an area that's around perhaps 2 or 1 even. And I know that sounds really ridiculous. The Dow Jones Industrial Average, I don't even know what it is at the second. Gold could get all the way up there, or the Dow Jones Industrial Average could fall, or a combination of both things where gold goes higher and the Dow Jones Industrial Average goes lower. And we go to a 1-to-1 relationship where they equal each other. That would take a strong inflationary environment and a vast outperformance of precious metals. Now, conversely, if we look at gold to the Dow Jones Industrial Average, we flipped the two. So it's not the Dow Jones Industrial Average, it's gold divided by that. And it's another way to actually view it. And I'll put it on logarithmic here. And you can see that we're basically coming into a corner here that we could potentially break to the upside eventually. We're not there yet when we price it in this type of format. On a non-logarithmic one, I can also kind of zoom in and put in another candlestick here, or a trend line, I mean. So if I do that and I zoom in and kind of back out, the trend line here, let me see if I can draw it a little bit cleaner here now that I've zoomed in. You can tell that we've basically broken out of the gold to Dow Jones Industrial Average of this short-term 2011 peak here all the way down to the bottom and a breakout. What that means is that in the short term, we could have a vast outperformance of gold and all the commodity complex because they're kind of tied to gold. Gold's we'll call it the liquidity leader. But gold and Dow Jones Industrial Average, we could see that outperformance. That outperformance could lead to the commodity outperformance as well. And that is freshly broken out here. So that's something to watch. Keep in mind, things break out, and sometimes they do a little retest before heading higher. So that is something that could potentially happen as well. Looking at gold versus oil ratio. And the gold to oil ratio is a pretty common ratio that people look at. And right now we're at 29. 29 is a very cheap ratio for oil. Now, I don't know exactly what this is going to do in the short term. One thing I will say is that 30 and above is very cheap for oil. I consider that to be kind of the ceiling of extreme undervaluation. What we could see in the future, depending on how the deficits play out in crude oil, I think that under a strong inflationary environment with deficits in the markets, which will lead to inventories being drained down, I think oil could outperform gold vastly here, and go back to a scenario like last time in the market of the mid-2000s, where the ratio went all the way down to 6 to 1. So below 10 for sure, but in the short term, gold has been outperforming given the fear in the markets. We're at a very cheap ratio, and this could pull back down. Another way that we can view this, if we flip it around, if we price crude oil versus gold, this is it flipped around. This is another way that we can also view this. And what I'll do is I'll kind of just throw this there, do another one, put another kind of line up here. So this here is where crude oil outperformed gold during that time frame. Here is where crude oil underperformed gold. And what we have coming up is a breakout and a potential retest here for crude oil to outperform gold. I like viewing it this way. I think it's a little bit easier to see how this is performing. And if this is the case, even though gold could do very well, crude oil could outperform gold dramatically. If I were to look at the outperformance, and I think gold's going to do some crazy stuff, let's say we go somewhere right below it, we could see an outperformance of oil of about 4 times the price of gold. Well, 5 times. That's 400%. So it's 5x gold, which means crude oil could do some really crazy things if it were to go back to those highs back in 2005 and 2008. So we could see a vast outperformance of crude oil. Now, that doesn't mean that it's just going to go straight higher. It doesn't mean that it's going to have to be immediate. Obviously, we've got some underperformance here in the short term, but I do think that we are coming very close to a bottom in oil against gold for that ratio. And this is where what I look at. And you can see you've got the 3 hump consolidation, the capitulation bottom, and then we're starting to break onto the upside. There's your breakout, and now we're doing a retest move. And you always know on the channel and on the website what I say. We always buy the retest moves. So that looks fantastic for crude oil. That doesn't mean I'm anti-gold by any means. I'm pro-gold, totally bullish on gold. But I think crude oil is also one that you want to not look over. So here's another one. This is crude oil in relationship to natural gas. You can see areas or periods where natural gas was relatively expensive. And we're coming from a very cheap era of natural gas. So if you look at the 2 blocks, this is an expensive area where the ratio is trading around 6 and below. This over here, we're trading at 20 and above for some of those cheap valuation levels. What I think is going to happen is that over time, if we have an energy crisis, which I think we're going to encounter at some point, I think this is going to come back below this average-ish area of about 11 or 12. And I think natural gas is going to outperform dramatically. And what a catalyst for that could be that the world runs very lean on natural gas over many years. And again, this is against crude oil, which I think is going to do incredibly well. So natural gas is incredibly cheap in relationship to crude oil. And when you get these large disparities of ratios, what this means is that if you can burn natural gas, they will burn natural gas over crude oil. If they can burn natural gas over coal, they will choose and burn natural gas. So that's how these ratios work. Whatever's the cheapest, the markets will design that thing into it. They'll put more natural gas power generation plants over coal if natural gas is cheaper. They'll burn more natural gas over crude oil if it is available and they can do that and make that substitution. That's why these ratios are so important. Now, going down, we're looking at the crude oil to Dow Jones Industrial Average. So this is crude oil versus stocks, so to speak. What we see here is this bottom. So basically you get a lead-in pattern and then you get the double bottom. And right now we're at that double bottom portion where we are incredibly cheap. This is going to take time. Obviously, this is one gigantic pattern that's created. This is back in the 1980s. And we're at a very cheap level in 2023. And we had a capitulation bottom in 2020. So I do think that crude oil has a long runway of outperformance against the Dow Jones Industrial Average. And it also tells us that potentially an inflationary period's coming ahead of us. What this is telling us behind is that from 2008 onward, we were in a disinflationary period. Same thing with this era here from 86 to 99. And then you can see a large outperformance there. And I think we're going to have a large outperformance where we could break all the way back up even if we are so lucky to get there. You can also see if we throw some patterns on here, that we have broken this consolidation pattern here to the upside, and we're starting to outperform against the Dow Jones Industrial Average. So crude oil is looking very good against stocks, or at least against the Dow Jones Industrial Average. The Dow Jones Industrial Average flipped over crude oil, just to show you a different perspective. Sometimes flipping these ratios against each other differently can give you a different perspective. Last bull market from 1998, which was a cheap point for crude oil, you can see it came up, it came back out and retested basically this breakout line, and then we came all the way back down and came to a low in 2008. We are doing something very similar today, where we had a very cheap level, just like this level here. We were compressing down. We came back out during that recession period. And I do think that we are probably going to hit an area very soon where the Dow Jones and crude oil basically top out. And crude oil will outperform after that point. There might be a little bit more weakness in this ratio where it will go a little bit higher, meaning that there's weakness in crude oil. But I think that's going to be one heck of a buying opportunity for crude oil and the companies that are selling crude oil and natural gas. So I do think where these orange dots are, we're probably going to come a little bit higher and probably tag it before heading lower. So that's kind of my guess of what it's going to do. And I don't know the exact how it's going to get there. Obviously, it means it's going to go up, but it doesn't mean that crude oil necessarily has to go down. It just means the Dow Jones Industrial Average could outperform in the short term, the very short term, maybe for like a month or two or three or something like that, or four, whatever it is. But that's what I'm looking for, and that's what we could see. The Dow Jones Industrial Average to natural gas, this paints a little bit different picture as well. We've seen a continual outperformance of Dow Jones Industrial Average over this time frame, but it looks to me like this is doing a double top, the Batman pattern or the double top. You can say it like that. And what I see here is we can kind of throw this guy there. We had a little false breakdown and a slingshot higher, but you can basically see we're in this kind of wedge that's going up. And I think we're going to top out. We knocked our head on the ceiling here of this megaphone pattern. Maybe we go up a little bit further. I think we'll turn down, and maybe we can go all the way back down to the bottom here, which would be a incredible outperformance of natural gas in relationship to the Dow Jones Industrial Average. What this is telling us is that we are at an area that is of extreme cheapness. And it was another time in history where you could have bought this in the bottom of 2020 would have been a good time, which I did buy. I bought the crap out of it in 2020 and rode this thing down. And I'm still in some of the stocks because the stocks really haven't pulled back as much. They're oil and natural gas. And I think we're going to have another opportunity here, which we've got now, to accumulate shares in natural gas companies and oil companies. And what this is saying is that it's incredibly cheap against stocks. And then looking at, this is bonds, so bond prices priced in gold. And if we were to look at this, you can kind of see we have this downtrend line. It was broken here, came back up briefly, and then came right back down. We've been compressing down lower. This is gold outperforming bonds in this ratio. You can see a vast outperformance during that inflationary period, an underperformance or sideways performance for the disinflationary period. Here's 2000, and I think we're going to continue to compress lower where gold outperforms bond prices. Looking at gold divided by bond prices, just to give you guys another look at it, outperformance based off of an inflationary environment. That environment ended, and then we've come on back, consolidated, broke out of this consolidation here, and we're starting to break higher. I mean, we're already running higher. And keep in mind that this is also a combination of bond prices going down and gold going up. So I think that we are in an environment that is like this environment here, which is this environment over here. And I think we'll continue to outperform, gold will, against bond prices. So that's what I've got for today, guys. Lots of ratios. Hopefully that gives you a little bit different picture, gives you a little bit more confidence in the pricing of these assets and what they're doing. This is what gives me the pricing. This is what I really look at. And this is where I find my buys. This is how I time them, is through these ratios. I might be looking at things a little bit different. I don't really care what other people say and what the market conditions necessarily are and how people think that they're changing. This tells me how it's changing and what it is. It's an unbiased view and approach to look at the world or to look at the markets in a way that gives you just straight data, so to speak. But I like looking at this stuff. I think that crude oil and natural gas are going to be incredible buys here, especially maybe over the next few months or something like that. Maybe gold will continue to outperform, but all it's going to do is make crude oil even cheaper. And it doesn't mean crude oil goes down. It just may not go up as much in over a period of time. So keep that in mind. It doesn't mean if the ratio goes down that both assets are going that one asset's going down, the other one's going up. They could both be going up. It's just one's going up faster than the other for a period of time. All right, guys. Hopefully you learned a lot. Give me a thumbs up. Subscribe to the channel. Subscribe to the website if you guys like. Become a platinum member. Join our community. We go over a lot of this stuff. We have ideas or I have ideas on how to play this. There's also other ratios that you guys can do by yourselves. You can not only price asset versus asset, but you can also price a company in relationship to the underlying asset that it sells. A lot of the times what happens is you get these setups where it's like 5 ratios or 4 ratios deep, where let's say you've got, there's certain things, especially this happens in natural gas a lot. So you've got stocks that are expensive. So gold's cheap to stocks, crude oil's cheap to gold, natural gas is cheap to crude oil, and then a natural gas company becomes cheap to natural gas itself, which means that if you were to price the natural gas company in relationship to the stocks like S&P 500 or Dow Jones, that it is just off the charts cheap. That's how I made a lot of money, is because some of these natural gas companies become so incredibly cheap at market bottoms that they actually reverse all the way back to the upside, making incredible gains against a bunch of other assets. So that's one of the tricks that I use to make a bunch, and how to identify the value at that time. That's the alignment that everybody wants. But that's what I've got for today, guys. Hopefully you're doing great. We'll catch you next time. This is Finding Value.